Hello and welcome to Wealthion's Weekly Market Recap. I'm your host, Andrew Brill. This week, Jerome Powell testified on Capitol Hill. We got a new CPI number that came in weaker than expected and a PPI number that was slightly higher than expected. The consensus is that a rate cut is on the way, though, in September. Let's get to the recap. The last time Jared Dillan has seen numbers like this, with the VIX being low and the unemployment number creeping up, was 2007, and we all know the economic strain we were in then. Jared also touched on where to stick your money depending on the outcome of the election in November and the high prices of housing and low supply. Jared, I want to ask you, what's your overall take right now of the economy? I know that's a broad question, but I'm going to ask anyway.
Well, things are slowing down pretty significantly. I mean, so we got payrolls on Friday, which was kind of sandwiched between July 4th and the weekend, and a lot of people weren't around. It wasn't a terribly strong payroll report, and you really have to go back to the previous payroll report to get any strong data whatsoever. So it's really been a month of weak data. You saw Jay Powell speak and say that he's seeing disinflationary forces, and I have to agree with him. Actually, he's a little bit optimistic. He thinks we're going to get 2% inflation next year or the year after. I kind of don't think that's going to happen, but nonetheless, inflation is coming down. If you look at the Trueflation numbers, they've been tracking below 2% for a while. So, I mean, the labor market is finally softening, which is something we've been looking for a long time. So I'm looking for lower yields in the future.
Powell's talking about labor markets. We did have that number, but it kind of, I know that a lot of people were on vacation, not looking at the market, but the market Friday had a pretty good day. NASDAQ and S&P hitting new highs, down not far behind it. What do you make of the market right now?
I can't make heads or tails of the stock market. It's really incredible. The NASDAQ is up 14 days in a row. It's like nothing matters, you know. And I've been in this situation in my career a couple times before. One of them was in I want to say 2006, 2007. It was a similar environment, very low volatility. I mean, back then the VIX was actually below 10 and it got below 9 for a day. And the market was moving 20 basis points a day. Liquidity was abundant in the stock market. There was very little volatility. And that ended on February 27th, 2007. And that was the day that we walked in the morning and China had raised reserve requirements and the ABX was down 10 points and the market went down 3% in a day and the VIX went from 10 to 20. And that was really the starting gun for the financial crisis. So you're seeing, you know, this, it's not to the scale of, 2018, where you had that kind of volatility suppression where people were piling into the short vol funds and stuff like that. But the similar things are happening now with covered call funds. There's a lot of vol selling. And, you know, if you suppress volatility, it tends to come back with a vengeance. And I think it's going to happen soon. So.
Do you remember what the catalyst was in 2007? I know reading your newsletter, you said it could be anything. It could be someone stubs their toe, and all of a sudden there's a huge sell-off. And
yeah, it was China raising reserve requirements and the ABX were the two big catalysts. So, I mean, I remember it clearly. I was on the ETF desk, and I had just gotten into work at 7:00, and at 7:30. Some hedge fund out of London hit me on 400,000 EEM pre-market, and it was offered $4 below where I bought it when the market opened, and it kind of ruined my day.
I was going to ask you about the election, not political wise, but in the market. There's a big difference between these candidates in what you're going to invest in, isn't there?
Oh, for sure. There is on every election. And it's kind of the same playbook. It's actually pretty boring. Like, it's the same thing every time. Like, you know, if it's a Republican, it's coal and energy and stuff like that. And if it's a Democrat, it's tech stocks. You know, I mean, there's this playbook that seems to work all the time. But there's the possibility, I mean, we don't have to get into Joe Biden's debate performance or anything like that, but look, there's potentially a lot of surprises. Like Joe Biden could not be the candidate, could be Kamala, could be somebody else, could be somebody who's competitive with Trump. So the idea that we're going to have the VIX at 12 all the way leading up until November seems kind of far fetched to me. So I think we're going to get some volatility.
Rates directly affect housing, and housing has been about as wacky as everything with higher rates, but there's less inventory, there's higher prices, which doesn't make any sense whatsoever. Can you make any sense of the housing market at all?
Yeah, it actually makes sense to me. I mean, like this is one of the few things that have gotten right in the last year. So basically, we went through a period of about 10 years from 2010 to 2020 where we were chronically underbuilding homes. We were just not building enough to keep up with population growth, and that home construction picked up during the pandemic around 2021, and we've been building homes at a much faster pace since then, but it still hasn't been enough to keep up with population growth, and it won't be going forward. So if you think about this, 10 million people have crossed into the country illegally, right? And they're going to stay here, and they're going to get jobs, and they're going to rent apartments, and over the course of the next 20 or 30 years, they're going to have children. Their children are going to buy houses. Like we we cannot build houses fast enough to account for the increase in population. I mean, this played out exactly in Canada in the 2010s. They started this immigration policy. They were letting in legally 2% of the population each year. There wasn't enough building. House prices went parabolic. Like, I actually think that home prices could go up significantly from here. Over on a 5 to 10 year basis. Not like this year, but over 5 to 10 years. I think it's possible for residential real estate to go up 50 to 100% from here. So, and it's really all about supply and demand. There was when interest rates first started to go up in 2021, 22. There were a lot of people who said, mortgage rates they went from 2.5 to 3 to 4 to 5. And people said, well, the housing market's going to crash because now, people can't afford these higher interest rates. Hasn't had any effect whatsoever. And I don't think it will have any effect. So, if you're long a house, if you're living in a house, I would hang on to it or buy more. So,
Dillan Smith of Rosenberg Research talked to us about the yield curve and how it might be turning around after being inverted for an extended period of time. The debt is still a concern, according to Dillan, even with a possible rate cut on the horizon. So the inverted yield curve means that the 2 year bonds, the interest rates are higher right now because that's what the Fed is really pushing because of the debt that we have, and the longer term bonds, the 10s, the 30s, those yields are lower. And
Exactly.
how do so when the Fed cuts interest rates, do you think that'll just automatically invert the curve?
Yes. So typically, you see an upward sloping yield curve. And the reason is because compared to investing your money for a short amount of time, so it's sometimes you look at the 10-year 3-month or the 10-year 2-year, you can get kind of guaranteed returns on that very short lending, and that's essentially pinned to the Fed funds rate. They control what we call the front end of the yield curve. Now, of course, you could reinvest your money every 3 months, every 1 year, every 2 years, whatever, and earn a consistent rate of return, depending on what your expectations are of where short rates are going to go, right? So if you think that short rates are going to stay the same, absent anything else, you'd expect a dead flat yield curve. But you also might think that, okay, but the economy is going to grow in the future. Plus, there's inflation I need to be compensated for those future cash flows, and that's what pushes the longer rates up, right? And that's a normal situation. That's the kind of situation which says there is a growing economy in the future, and that's what banks base their business models around, is lending now on future investment returns. But what we're seeing at the moment actually is that basically bond markets are telling the Fed, we think short rates are going to be lower in the future, which means, A, we don't think growth is going to be so high that it requires you to have very tight policy, and neither do we see major inflation risk coming down the tube that would lead us to put a premium on that, which would make the yield curve upward sloping. And so the way that uninverts in that kind of situation is to bring down the front end. In other words, to mean revert the yield curve, the Fed needs to cut rates, right? And you do usually get the whole curve flattening a little bit. So we would almost definitely see the 10-year rate with a 3 handle on it get to like 3.5% if the Fed cut down to say between 2 and 2.5%. And that actually generates a very high real return because of non-linearities and how bond returns work, which I won't get into now. But point being, it is the Fed who has uninverted the curve. They don't control the long end, especially when they're not doing QE. And it is the Fed who will uninvert the curve again.
Does it behoove the Fed to sell longer term bonds than the 2-year bonds?
Yeah, well, so it's the Treasury who sells bonds. But
right.
One of the most massive and difficult to explain policy decisions that we've seen by Treasury Secretary Yellen is, during the period of very, very low rates, she did not issue at the long end, right? So she could have locked in a huge amount of government funding at 10 years, at 30 years, for 2%. And instead, the Fed actually shifted to shorter dated issuance during that period, which is now all rolling over. And so there's a lot of issuance coming into markets that needs to be issued somewhere. With rates being very elevated, it's not easy to win in that scenario. And so what that means is that the interest burden of the U.S. government is going up and will continue to go up because that gets locked in as stuff rolls over, right? And so that's one of the things that's making markets a little more worried, especially on the longer end of the curve, around the 10-year, raising some questions about, okay, how sustainable is government funding if, A, you're going to be quite loose, debt's already high, and you're increasing the cost to carry that debt, right? And so, yeah, that is definitely a problem and a very big missed opportunity not doing it previously issuing on the long end of the curve.
I have a question about the volatility of the market. Right now, the VIX, the volatility meter or gauge, if you will, is right around 12, which is extraordinarily low. So not a lot of people worried too much about the market, but unemployment is creeping up. Last time we saw something like this was right around 2007, and there was a very significant drop. Do you see that as a possibility? There is a correction coming. We know that, whether it's 5%, 10%, whatever it is, could it be drastic?
It could be. I think how drastic it is depends again on news on the Magnificent Seven themselves, whether or not it's just people sort of tailing back or whether there's something that causes a rethink of basically earnings projections for those companies and the AI theme a little bit, as you would have had in the late 90s, right, for some of the tech players and 2000. But yeah, I mean, in terms of what the VIX is telling us, complacency. Volatility is low because everyone has decided on the narrative and is trading the narrative every day. And there's very little that is changing that narrative right now. And so you just get a steady creep up and very little in the way of measured vol. It's not a coincidence that happens just before times when we tend to get corrections in the market, because that always happens when there are surprises and complacent investors get surprised. So it's not the most reliable indicator. In fact, it would be doing the opposite of its job if every time it went down, markets were about to blow up. But the longer it stays there, the more it tells you that there's kind of a bit of fragility building up into the markets.
So last thing I want to talk about is the debt. Almost nearly 36 trillion at this point, and with interest rates not coming down, we need to service that debt at a very expensive rate. Obviously, a rate cut will help in a minuscule way. more would definitely help. Where do we go from here? Because neither one of these presidents is going to stop spending money.
Well, more rate cuts help as long as it's not seen as license to borrow more. So it all comes down to the fiscal policy that happened. And as we discussed earlier, that comes down to the balance of power after the election. But the sort of bold fact is that nothing in this election campaign has been about consolidating the national debt. No party is running on the honest idea that the U.S. needs to renegotiate its social contract in order to manage down its debt. There are sacred cows that need to be looked at, which neither party has any interest in looking at, and which it would, to their credit, be very unpopular in election season to start raising things like we need to adjust Social Security, etc. But that's the only way. It's the only way. And the sort of buildup of higher incremental cost of borrowing is already happening and will continue to happen unless the Fed floors rates to zero across the yield curve, which is not possible. So it's a big reason for concern. Equally, these things don't happen all at once. It takes years and years for a fiscal crisis to build up and develop. And so, the line we're running is that the 2028 election will be run on the debt. And it's going to take a whole build up. Now, as we've said, if Republicans are in control across the board, that is going to make that deterioration more rapid, more inflationary. And so, that's one outcome that we should be on guard for. But equally, we don't see a way for cross-party consensus to deliver a sensible and growth positive consolidation in the event of a Democrat winning the White House either. So it's going to get worse before it gets better on the debt side.
Bitcoin, gold, and commodities were on Jay Wood's mind when he joined Wealthion this week. He also talked about the expected market volatility during election cycles and the evolution of the New York Stock Exchange.
So, Jay, you are currently in your office, but you are one of the few remaining people down on the floor of the New York Stock Exchange. Why don't you give us a little bit of history about that and how many people still work on the floor of the New York Stock Exchange?
Been there. I was started in the New York Stock Exchange 32 years ago next week, and there were 5,000 people. It was vibrant, yelling, screaming, auction market. I was a big part of that, and then I was a big part of the evolution, or some people say the de-evolution, as we lost that human element. So I've been able to transition through those times and pivot in my career. But the floor is not what it once was. It's not that vibrant, crazy place, but it still holds a very special place in my heart as my home. And, home to our team down there at Freedom, as well as our team up here on the desk where I'm talking to you from today. The exchange continues to evolve. And unfortunately, because of technology, you don't need 5,000 yelling and screaming people to auction and bid and offer every single share that trades. So we've seen the amount of people, the head count shrink, but those people down there, they still have a valuable role. Having human judgment at point of sale, I think, is the most important thing you can have, especially during turbulent times. So the NYSE is a great showcase for our listed companies and those bells, and it's iconic. But the people that still work there, they have a valuable role, and I don't want to, poo-poo that.
I can't believe there was 5,000 people at the peak. If you were to guess, how many people work on the floor now?
How many people? I think the floor staff is just about 400. So it's been about a 95% haircut. To put it in perspective, when I was with Goldman Sachs during most of my career, 2000 to 2014, we had 330 employees as market makers. When Goldman left the operation in 2014, you add technology increasing and then a financial crisis. There were major layoffs, and we know what happened with Bear and Lehman Brothers. We went from 330 people down to 15. So I was able to adapt and adjust and change and survive. But now I've been able to pivot, and I get to talk about the market, talk about some of those great experiences, and still get to hang my hat, or in this case, my smock, down and at the trading post down at the New York Stock Exchange. So it's still a great place.
So I want to get your thoughts on the broader indices now. The S&P and the NASDAQ, they're doing very well. It's like they're making new highs every day or every other day. What's your sense here in the coming months? Do they continue to grind higher?
I think they do, but I think there's some volatile times ahead. All right. First of all, the elephant in the room is the election. And we have in the United States, we are going to have one heck of an election. It's already off to a glorious start. We still don't know who the final candidate may be on the Democratic side. Hey, we don't even know if the Republican candidate may make it. It looks like he will. But during election cycles, you will get pockets of volatility heading into that election. But once you get to the election, you tend to finish the year strongly. The fourth quarter in an election cycle, we get a decision. We get decisiveness. Let's go back to 2016 in the U.S., controversial election. Everyone thought Clinton was going to win. It was Trump. And the futures that night were down dramatically. We opened lower. We went higher. We kept going to the end of the year. 2020, another controversial election, one that some people still deny. But I can't deny price action. Price action bottomed on election day, and we went higher. We even made a new high 2 days after the January 6th riots. So the politics, while they'll make headlines, I tell customers here, just put on earmuffs. You want to block it out. You want to focus on the action. And historically, the trends are set up that we do well. But before we get to that November election, yes, August, September, the two worst months of the year. The last 10 years, August, September have only been up 4 times. And they're down a little average. I think it's 1.7%. I had my intern doing that research for me. I have not verified his work yet. But I just know that August to September, from a seasonal pattern, the 2 worst performing months of the year. October, one of the most volatile months of the year. We get most of our bottoms happen in October. And I think the stage is set. You asked about the S&P and the NASDAQ, both having tremendous years. All right, we get an average of 3-5% pullbacks a year in the major index, the S&P 500. We get an average of 10% correction. We have not had a day where we've gone down 2% in 345 days. I think there are going to be pockets where you're going to get that pullback. They tend to happen in August. I don't know why, but maybe it's because everyone's going away, no one's paying attention. But I think a 5% retracement, that would be normal. We'll get you back to 5250, 5300 in the S&P 500 as we cross 5600 as we tape this. That will sound dramatic. It will make headlines. But as someone that follows long-term patterns and long-term trends, these are normal occurrences. But when it happens with the backdrop of political rhetoric, then it takes on new headlines. But I think we are going to see some earnings guide us, and people will be selective of where we go. I still think the financials should be in good shape, but there will be pockets. And when stocks have missed or not guided well, we saw this in the software stocks. When they haven't had a good AI story in the software stocks, they get punished. Now, they're rebounding. They're coming back pretty nicely. But we've seen some extreme volatility around earnings, especially in the tech sector, when they don't perform up to standards. Look at Intel. Look at what Adobe did. Look at Palo Alto Networks. They're coming back. But, man, were they beaten down for, weak or average guidance compared to some of their peers.
And do you have any thoughts on Bitcoin or gold?
Yeah, well, gold is one of those head scratchers. I am not a gold bug. I'm not a gold expert. It had a tremendous run technically. It's broken out long term. It looks fantastic. The inverse relationship, the hedge, I thought Bitcoin was supposed to be a hedge when technology wasn't doing well, but now 5 of the Mag 7, if NVIDIA's almost there again. 6 of them are making all-time highs, and Bitcoin is breaking down. I think Bitcoin will do well under both administrations. Biden has done some things to make it friendlier. Trump is now on the Bitcoin bandwagon as well. But no, we don't follow, cryptocurrency here at Freedom. So what I look at is I look at the technicals, and I know it's broken down. You want to see Bitcoin recapture 57,000, and then you could possibly have a leg higher into the mid-60s. But overall, for people that said this was the inflationary hedge, it never is acted consistently for me to give it much credence. As far as gold goes, gold looks fantastic. Copper looks great. You're seeing a lot of these, materials that will be part of the AI story that help build the infrastructure, like a copper, like uranium doing well. And then I think the utilities, there is a story there. They're going to need that power. They had a nice little run up. They pulled back. They're probably set to rally as well if we can broaden this rally out into year end, like I think we will.
Yes, Bitcoin is interesting because we were always told it was a risk-on type of trade, and we definitely have a risk on market right now just keeps ripping higher, but Bitcoin keeps going lower. So it's going to be interesting to see what comes of that.
Wealthion's friend Jon Najarian of Market Rebellion joined Anthony Scaramucci on Speak Up this week and reflected on learning the options trade and explained how he goes about finding options to trade. He also spoke about the pressures that crypto is facing versus the stability of gold.
You were willing to adapt and adopt. And that's what I've done for 42 years in my investing career.
John, it was scary and it was painful. And I'm going to show you something because I think you'll get a kick out of it. And this is for viewers and listeners. This is stuff, these are notes that I wrote to myself in 2022 when I was dying. Okay. And this is a note to self. When you're having a bad time in life, pick up the phone and call your friends like Jon Najarian. Okay. And so you were always kind to me in my rough moments of my career. And I think it's very important for people to remember they can get through these rough moments as investors or as people.
Yep.
You built a number of very successful businesses. You love the options markets.
Mm-hmm.
You've invited people to learn about those through you and your brother. You've put out books related to this. Please give us a sense for why you love the options markets and why should individual investors be attracted to options.
Sure, happy to. Number one, they can define their risk when they enter. When you buy a stock or a crypto for that matter, you have unlimited upside and limited only to zero on the downside. And most of us need to pay more attention to those risks rather than the potential rewards. So when you buy an option, that's all you can lose. So you're just trading a somewhat perpetual instrument like a stock or a crypto. You're trading that for something with a defined time frame. Maybe it's a 1 week option, maybe it's a 6 month option, maybe it's a 1 year option. But you can define your risk when you enter the trade rather than saying, gosh, I'm really feeling the pain. I think I should get out now. As we both know, if you did that in 2022, you got out for $18,000 per Bitcoin. And then they rocketed this year to $73,000 or higher. So you don't want the market to take you out. You want to decide when you're going to exit. And you get these blinders on, Anthony, when you're experiencing those losses. Sometimes the loss is, a personal loss, like a father, a brother, whatever. Other times it's financial loss. And those blinders keep you from seeing all the other good things that you could be doing at that moment. So options, I think, let me define my risk and let me get a leveraged return on my investments so that I'm not just making, 3%, 4%. Those are great, but I want to make 30%, 100%, or 10x, those kinds of things. And you can do that with options.
How many years you doing this, Jon Najarian? How many years?
Well, I started in 1981. So
Okay.
for an awful lot of you watching Anthony's show here on Wealthion, that is a long time. 42 years, 43 years, that's a long time. This will be my 43rd year in October. And I'm delighted to be doing it still. I'm excited by it. Again, there are always things that I can morph into. I can trade options on Bitcoin or Ethereum. I can trade futures on those. I can trade and ride the NVIDIA and AI wave. I mean, all of that is exciting to me, Anthony. And as you know, we get to basically tie in any news in the world, whether it's politics, whether it's commodities, whatever news that's happening in the world, it's impacting one of the stocks that you and I trade. And that's what makes it also interesting and keeps your brain, rolling along rather than just turning into mush.
But I'm saying this for a reason, though, John. You had the enthusiasm of a 25-year-old that just entered the space.
Mm-hmm.
So what's the lesson there? How do you keep yourself game ready? How do you keep yourself enthused? For me, it's always the newness of the markets. I feel like you and I are in the business of constant involvement and constant understanding of the shifting currents of business. But what is it for you?
Um, it is that it's applying whatever the expertise that, again, professional traders like Anthony and I have accumulated skills over these years. You know, to use the Liam Neeson quote from Taken or whatever, I've acquired a certain set of skills that make me very dangerous to people like you. um, I love the idea that I can be excited by the different angles that I can attack a given investment, Anthony. So, for instance, AI. I love AI. I love Micron. I love ARM Holdings. I love Super Microcomputer. I love so many of the things on the AI side of it. But what else is there out there? Well, that's the job of people like Anthony Scaramucci and Jon Najarian to go out there and figure, okay, it's really thirsty for energy. So what does that mean? That means I need something like clean energy, like nuclear. I'm going to invest like crazy. These stocks are up as much as NVIDIA is up. Camco, which is a uranium producer, it's up 7x, 7 times what the price that it was just a couple years ago. I'm going to be buying a lot of that. I'm going to be buying a lot of NNE. This is a micro nuclear reactor. And some people might say, micro nuclear reactor, what about terrorists and things? Nuclear energy is very safe, super clean, but of course, there are issues. And one of the issues is, you know, to get these things permitted takes decades. To get them built takes decades. Well, so what if you had something that's the size of a Generac generator? You know, in other words, a large file cabinet that could basically generate all the power you need for a facility like the one behind me, the one that I'm sitting in right here, SIBO Global Markets. What if you could do that? That's what a lot of these companies do, Anthony. So data centers, you know, VRT and these big data centers, those are the areas that I'm exploring and that I'm investing in because of AI, because AI is pulling from all these sources of information around the world. So AI would know before we do, you know, that Kazakhstan just put a big premium on, for instance, uranium extraction in their country. What does that mean? Well, supply and demand still drives prices. So if you have less supply and more demand, I can tell you where the prices are going. So AI could figure that out faster than you and I could. And AI would be reacting to that last night when that came out, rather than today during the day after these uranium stocks have popped, just as one example.
Right. Good point. All right. So we're both crypto enthusiasts.
Mm-hmm.
So you tell me what's going on in the crypto markets. What's going on with Bitcoin? Feels like Bitcoin hit a wall just above 70,000. It's backed
Mm-hmm.
off into the 50s.
Mm-hmm.
Should I be worried about that as a crypto investor? Should I be buying here? What's your thoughts?
Well, just like you, and I keep saying that in this interview, folks, but there's only this much separation between John and Anthony and how
Well,
we have
there
grown in
isn't.
our
You're
careers.
like 6 foot, 6 feet taller than me, and you have 50 pounds more muscle than me. You know, you're the type of guy. If I walked into a bar, I say, "Where is that guy's girlfriend? I got to stay as far away from her as possible, so I don't end up through the window of the bar." But go ahead.
Um, when I'm looking at uh, what's going on in the markets and things like that, I really focus in on um, risk versus reward. Like I said at the top, I think that's one of the most important things that we have to do is focus on that risk versus reward. Um, you should always ask yourself, folks, how much can I lose? Not how much can I make? Because we can make money and a monkey can make money. My dad was a surgeon and he used to say, Anthony, I can teach a monkey to do surgery, but it's knowing what to do, especially when things go wrong.
I'll
Um,
remember that, Najarian. The next time I have a surgery, I'll be thinking of the
yeah, you'll be
primate
thinking
cutting into
about
me.
exactly. But I think that there's so many angles that we could take with investing and with crypto. I think crypto, I was a seller over 70. I've bought it back last week when it broke down to 55 or 54. I never buy the bottom, I never sell the top. So I'm not telling you that I did that, folks. I sold it a little over 70. I bought it back at like 58 on that short position. And now, would I be adding in the mid 50s? Yes, I would. We're talking about Bitcoin to USD, to the US dollar, folks. Yes, I would. But I do think that the Mt. Gox issue is a big issue. I think that we've got Mt. Gox, those coins, $9 billion worth of Bitcoin that was on those, on Mt. Gox, on that exchange, if you will. They're going to be given back to the people that rightfully owned them. They've been locked up for a decade as all this works its way through the courts. So do I think that that's pressuring? I think at least people believe that it is pressuring the markets, because many of those people own these coins from pennies, maybe even, single digit dollars, and now it's $57,000. Would you think that some of those people would be so grateful to finally get their coins back that they might be taking profits? That would be what I would think, Anthony. And I think that's the overhead pressure that's pushing down on Bitcoin at this time, and the sentiment that could be happening. Whether it does or doesn't, that's the sentiment right now.
Okay. Up against that, though, let me get you to react to this. There's 16 or so billion dollars of cash that's going to be dumped on FTX. These are the former account holders of FTX, Sam Bankman-Fried's firm. What say you to that?
Well, again, giving people what was rightfully theirs, and unfortunately, I try not to leave my coins on any exchange, folks. I made a mistake and did some of that with the FTX situation. Shame on me for doing that. But now that those of us who did that are getting some, probably not all, but some of that money back, again, that was when Bitcoin was in the, certainly less than 30, and it was in the mid to low 20s and falling when Sam failed. And it was failing because, people just didn't believe that one of the biggest exchanges on earth for cryptocurrency could possibly be a fraud. And unfortunately, that's what he was convicted of. So I'll call him a fraud.
Right.
Hopefully, most of us get a very good portion of our money back. I know you were a big believer in him, Anthony, and certainly I was too.
My business to him. You know what I mean?
Yeah, I was too. So unfortunately, and a bunch of big Silicon Valley firms like Sequoia and others were big believers in Sam. He played a great game, and he made it look like he really was everything that people projected onto him.
Thank you for watching this week's recap. Don't forget to head over to Wealthion.com for a free, no-obligation portfolio review with one of our registered investment advisors. And please follow us on social media for the latest news and information to help you invest wisely. If you haven't done so already, please make sure to like and subscribe to our channel, and don't forget to turn on the notifications so that you never miss a video. Thanks again for watching. Until next time, stay informed, be empowered, and may your investments flourish. If you like this content and are looking for more ways to keep growing your investments, watch this video next.